Hello everyone, it's been a while, so welcome back. Today I'll be talking about one of the important financial metrics used by investors to analyze companies. That is EBITDA. Let's dive into the video. When you want to invest in a company, the first thing you do is analyze whether the company is even worth investing or not. That is when EBITDA comes in use. So there are all sorts of ways in which investors measure the financial health of a company. They look at sales, cash flow, consider various assets and any outstanding debt. But beyond these traditional tools, one of the most common measurements in determining a company's value is EBITDA. EBITDA is an acronym that stands for earnings before interest, taxes, depreciation and amortization. It is a metric used to evaluate a company's operating performance. So a company's EBITDA is a snapshot of its net income before accounting other variable factors like interest payments, taxes, or depreciation of assets. By removing these elements from the equation, this metric provides a clearer perspective on the operational performance of a business. I know this may sound a bit confusing, so let's look at some real-life examples to simplify our understanding. This is what an income statement or a P&L statement looks like. So let's look at how to calculate EBITDA with the help of this company's financial statement. To calculate EBITDA, we add net income, interest, taxes, depreciation and amortization. So the net earnings, that is 14,360, we add interest, that is 50, taxes, that is 3,590 and depreciation, that is 500. Since there are no amortization expenses of this company for this financial year, the amount is equal to null. So on adding these, we get EBITDA, that is 18,500. After a company's EBITDA is calculated, this number is then divided by its revenue to produce the EBITDA margin. As we all know, the higher the margins, the better the company is performing. Taking EBITDA, that is 18,500, and dividing it by the revenue, that is 22,000, we get the margins, that is 84%. As the EBITDA margin is 84%, the rest 16% of revenue is used for operating expenses. One thing to always remember is that every sector is relative and so are its margins. So a particularly higher EBITDA margin, say for sector A, may be a lower EBITDA margin for sector B, and so on and so forth. Let's understand this in more detail in a bit. Now let's look at the components of EBITDA, which are the variable factors that we exclude while calculating it to obtain the net operating profits of a business. Firstly, we exclude interest as it depends on the financial structure of the company. Different companies have different capital structures, resulting in different interest expenses. Hence, it is easier to compare the relative performance of companies by adding back interest and ignoring the impact of capital structure on the performance of the business. Thus, interest is a first factor deducted from net income, resulting in giving us a deeper insight to the core profitability of the business. Nextly, we have taxes. Taxes vary and depend on the region where the business is operating. They are not a part of assessing the management team's performance and thus are excluded while analyzing the operational performance of the company. Then we have depreciation. Depreciation depends on the historical investments the company has made and not on the current operating performance of the company. Companies invest in long-term fixed assets like buildings or vehicles that lose value due to wear and tear. The depreciation expenses are based on a portion of the company's tangible fixed assets that are deteriorating. Thus, we exclude depreciation while calculating the net operating profits of the business. Lastly, there is amortization, which may or may not be there depending on the business. Amortization expenses are incurred if the assets are intangible. Intangible assets, such as patents, are amortized because they have a limited useful life. And that is why they are excluded while calculating the operating profits of a company. To conclude, all the factors of EBITDA are excluded as they are variable in nature. The primary objective of investors is to assess whether businesses are making money or not at the core level without any underlying factors impacting it. And that is why we use EBITDA as a tool to find out the operational efficiency of the businesses. Now that we understood what is EBITDA, let's look at why do investors use it and what does it imply as a ratio. EBITDA mainly determines whether a company is worth investing and at what price multiple. It adds more insights to investors by comparing the underlying profitability of companies and its competitors. To simplify this, let us look at a few real-life examples and see how do we use this ratio. The two ruling brands for soft drinks in the FMCG sector are Coca-Cola and Pepsi. Let's look at the data given for a particular financial year. By observation, Pepsi has a larger revenue in comparison to Coca-Cola, so we can conclude that Pepsi is a better company and thus a better investment. But now, when we look at the EBITDA margins, as a surprise, Coca-Cola has a higher EBITDA margin despite having a lower revenue. It shows us that Coca-Cola is making more profits than Pepsi despite a revenue gap of 42%. This implicates that Coca-Cola is using 72% of its revenue for operating expenses, which is lesser than Pepsi, who's using 81% of its revenue for operating expenses. Thus, EBITDA acts as a screener indicating whether a company is even worth investing or not. Then I can further analyze the company using other financial ratios and judge whether it is an investable opportunity or not. So one cannot conclude anything based on a single metric. There are always several other financial ratios which help you analyze the overall financial health of a company. Now let us look at another illustration for better understanding. This is the hospital sector, wherein an IPO last year, Kim's Hospital went public. To decide whether this opportunity was worth investing or not, let's look at its competitors and get a competitive analysis. As you can see, Apollo is the highest revenue-making company in this segment, but it has the lowest EBITDA margins. Whereas Kim's, that is the business prospect we are looking at, has the highest EBITDA margins with a decent revenue relative to its competitors. Here is where the EBITDA ratio comes to the utmost importance. EBITDA acts as an indicator that Kim's is having higher margins despite a lower revenue, which shows us that there is something unique and different in its business model, enabling it to make more profits at the core level. So this ratio basically gives a hint to investors whether they should further analyze this business opportunity using other financial ratios or look at other companies. Lastly, let's look at one more illustration to completely understand the core application of EBITDA. Here there are two lemonade companies having the same revenue and EBITDA. So as an investor, how do you decide which company is a better investment opportunity? Hence, let's compare the financial breakdown of both the companies. Lemonade Company B uses substantially more debt, that is 150, to finance its operations, but it is less profitable in terms of net income in comparison to Lemonade Company A. Hence, Lemonade Company A would be worth more to investors since it is able to turn more of its EBITDA into net income, whereas Lemonade Company B isn't as profitable because of its debt expenses. Now that we've understood the core application of EBITDA, one thing to always remember is that EBITDA is variable to sectors, so the EBITDA multiple varies greatly from sector to sector. Let's simplify this through an example. Here Facebook has the highest EBITDA margin in comparison to Apple and Google, but this does not imply that Facebook is better than Apple because both of them belong to completely different sectors. Facebook has a service business model, whereas Apple has a production-based model. Thus, EBITDA is only used to compare businesses with its peers in the same sector. And that's a wrap for today. I hope you all understood what is EBITDA and the core application of EBITDA as a financial ratio. Do like, share and subscribe, and thank you so much.